And today I'm going to investigate whether it makes sense to buy a property and live in it, or whether you're better off renting a property and deploying that same amount of money in some other investment like a stock market or your own venture, etc., etc. Now, uh, buying a property is not always, especially for living in, is not always a purely financial decision. You want to be in a nice neighborhood, you want to think about the school zones, you want to be able to paint the house, you want to be able to modify, etc., etc. Plus you want the certainty that comes with living in your own house, and that's not something which a rental house will always give you. On the flip side, buying is not always an option for everybody. Let's be cognizant about that. Buying a house requires a significant amount of upfront deposit. You need a regular, predictable cash flow, um, serviceable income, etc., etc. And it's not always an option for everybody, especially to buy in the neighborhood which they actually want. Uh, so it's not always a pure financial decision. But if you had the choice of having the deposit, etc., etc., and you're contemplating whether you should buy or you should just rent, then these are the numbers you should be looking for. Uh, Now, let's say that you want to start by uh, you want to live in a property which is about $1 million worth, which is quite the norm in Australia, fortunately or unfortunately. Uh, and the rental yield is typically a term which is used in terms of what a landlord would look at, but you'd be around 3.5% of the property's value. Okay, so year one rent could be 35,000, and you can expect the annual increase in rent to about 5%. Now I'm going to share the sheet so you can play around and do your own numbers, etc., depending upon your own circumstances, and change it as you like. So uh, go crazy. So year 2, 36, year 3, 38.5, year 4, 40, year 5, 42.5. So you would end up paying about 190K, give or take, in rent. Uh, and let's say you deployed 20% deposit, okay? So $200,000, and you deployed, took all the money and went into the stock market. Uh, and you are getting about an annual return of 14%, which is on the generous side, but not always unheard of. You could make more, you could make less, you could go behind as well in some certain cases, which is unfortunately the reality of the stock markets or of any investment in general. Uh, so I'm gonna go with 14% for being a bit generous to the stock market equation. Okay. So year one, your $200,000 investment would be worth 228. Year two, 259. It's all compounding. After year five, you could be worth 385. So, okay, so you deploy 200K, and now you are worth about 385K. Okay. Uh, Now the total amount of money which you would be deploying in the over a period of time, which is your initial deposit plus the money which you spent on rent. Okay, so this is what you spend on rent, and you deposited 200,000. So 200K plus 193 is about 393. So this is the amount of money which you are out of pocket. Okay, and if you make 385, then your absolute return is actually negative. So you are losing a small amount of money, but remember that this has more or less paid for your living. Okay, so 14% is likely not going to cut it if you are living in $1 million property and having 3.5% in terms of rent. Okay, so let's see what 15% does. Uh, yeah, you're coming out a little bit higher. So you need about 15% to come out neutral. Any higher, then you're going to do much more. So unless you have more than 15% expectation in terms of what returns you're going to make, uh, you are generally coming out neutral or a little bit behind. Okay, let's take the same example about how much you're going to make in property. So $1 million property and $200,000 in deposit, same amount we are going to put towards deposit. Now your loan is going to be 800K, but remember that you also have stamp duty and other closing costs. So what I've done is I've accounted for that. So I've added that to the loan because that's what most people end up doing. They end up borrowing that much. and I'm going to assume an annual interest rate of 5%. Now, right now in Australia, it's 6%, but I have seen interest rate as low as 2% or even lower than that. And right now, I'm kind of the opinion that the interest rates have more or less peaked, and from here on, they will either remain flat for a while or they'll go down. I don't really anticipate them to go much higher. I could be wrong, but I think an average of 5% over 5 years is a very reasonable expectation. Okay. Also, loans comes in all flavors and sizes. They can be longer, principal and interest, interest only, LMIs, etc. Low deposit, high deposit. I'm going to assume 30%, and number of payments 12 a year. Some people pay fortnightly, weekly, monthly. Uh, the numbers are not going to change materially due to these things, uh, except for if it's an interest only loan, which I'll discuss later on. But for now, I'm going to go with something which is fairly common. Okay. Uh, and this video is generally indicative. You can come up with your own formulas, etc. as well. So 360 payments over 30 years. Uh, the payment per period is going to be looking around 4.5K. I've created a mortgage sheet over here, which sort of has the breakdown over here. So when you do a mortgage payment, as a lot of you are probably already aware of, a portion of it goes to interest and other portion goes to principal. So initially the interest portion is higher and the principal portion which you are paying down is lower. And as you progress, it slowly increases in favor of the uh, principal, because the interest starts getting paid down and the overall principal you have is lower and lower. So the interest reduces in general. So the interest portion starts going down. The principal portion which you pay in your EMI is going to be higher and higher. Okay. And if you go back over here, what's going to happen is, actually, let's go back over here. After 60 months, which is 5 years, you're going to pay about 202,000 in interest, and that's money out of pocket. Okay, so a lot of people tend to think that, okay, everything is going towards your property's payment, and you're building up equity as you go. While that is true, that is not the complete story. A significant portion, especially in the first 5 years, which is on average what Australians tend to hold on to a property for, is going towards the interest servicing portion of it. So yes, you do accumulate equity, but it's going to be much lower. This equation does change over a period of time as you keep on holding, but in the early days, early 5 years, you're going to be paying much more in interest as compared to accumulating equity. So you're going to be out of pocket by around 271K. Now the good news is 68K is coming back, and it's also going to work towards generating returns for you in terms of your capital gain, but your total money deployed in addition to your 200K is 271K. Now this is where when I said at the start, it's not always feasible for everybody. This is what I was talking about. This number is going to be higher in general in terms of your cash flow as well as your monthly deployment. Uh, your monthly cash flow is going to be a bit more stressed when you are owning a property as opposed to renting. Okay, uh, but a portion of it is coming back. Now it is very important to be clear-eyed about how much is coming and how much is actually just the cost of servicing the interest, especially when you are dealing with uh, an interest only loan. Then as the name suggests, it's interest only, it's not really generating you any equity. So that means that you are not really all you're doing is like renting effectively the capital from the bank, and then having the privilege of owning the property in your name and hoping that there is capital gain. Then you would end up making some money, but the reality is you are basically servicing the bank. uh, and also, capital gain is not a given in all types of properties, especially in apartments or very small units. You don't tend to get as much capital gain. So if you can, and you are looking to invest, buy a house with land, ideally big land. There are other things as well, but uh, that's the reality. Okay, and now uh, what I've done over here is I have assumed annual capital gain of 6%. Uh, it could be higher, it could be lower. 6% seems very conservative. In fact, I would say 7% is reasonable. Let's go with 7%. Okay. Uh, Now, property value after year one is going to be 1,070,000, year two 114, year five you're looking about 140. Okay. Uh, so if you decide to sell after year five, then uh, what's going to happen is you have accumulated 68.9 in equity, which is going to get reduced from your initial loan of 844. Okay, so your loan which is remaining after that, which the bank is going to take from the proceeds of the sale of the property, is going to be 775K. And property sales usually has a cost. You have to pay for marketing, you have to pay for uh, sales commissions. So I'm going to put in 2.5%. So the net proceeds, I would say, is around 1.36. Okay, and once you pay down the remaining loan, which the bank is going to take away because that's their share, that's what they paid for, and that's what is remaining, then you are going to be left with 592K. Okay. Now, you also have to factor in that you are paying rates, you are paying for land tax, etc., etc. I assume that to be around 4,000 a year, which is okay. I mean, like it's slightly on the higher side, but if you average it out over a period of 5 years, then this seems okay. So, and this is the interest portion of your mortgage payments from here. This is from here. And the total capital deployed over 5 years is going to be your initial deposit, which was $200,000, and what you paid in rates as well as your mortgage payments. Okay. Uh, so it's going to be around 200K plus 271K plus 20K. Okay, so that comes to around 491K. Now, this is what your proceeds were after you sold the property and the loan was repaid. So you are making about 100K profit, which is a return of on this much amount. It's around it should be actually a percentage figure. Sorry, sorry, I made a mistake on it. But you are making about 100K on a total investment of 491K. So that is about uh, roughly 20% return over 5 years. Okay. Now, and in addition, you are offsetting the cost of your living, and also you got to live in the house which you like and enjoy. Uh, Plus, it's a reasonably safe investment if you know what you're doing. So, if you have the privilege of being able to afford the deposit and you are able to acquire a property which you like and are able to service it, then without doubt, uh, the reality is you are not going to make about 15% every year uh, in the stock market. There will be some years in which you are going to be behind. Now, I'm not advocating that all of your money should be in property alone. In fact, there's a long rant I'm going to make about how Australia sort of is over reliant on property in terms of investment. We need to deploy uh, towards value creating ventures and not just rent seeking, which is property. But the reality is, right now, if you look the numbers and stack them side by side, then uh, you will generally come ahead if you buy and hold a property. So believe it or not, in this particular case, the agents are actually right. I don't know whether renting a property is servicing somebody else's mortgage, because that's something which we haven't exactly reviewed over here. And I am actually going to do another video about rent vesting, which is basically renting to live and then uh, investing your property, buying investment properties where you are a landlord but you're actually renting from somebody else. So there are other permutations and combinations which go into that, which involve negative gearing and whatnot. So that's a different conversation. But if you're just going to look for a place to live in, then it actually also makes financial sense, apart from the fact that you will generally come out ahead and have a property which you enjoy and are able to consider your own. you will also generally be coming out ahead. There are some other advantages when it comes to selling a property which you own, which is at least in Australia, or at least in Victoria. I'm not sure about the federal level, but if it's a principal place of residence, then the money which you make from selling the property, you have a beneficial treatment in the capital gains on it. But that's the story so far. If you have the privilege of having the deposit as well as the ability to service the mortgage payments which are expected by the bank, then without a doubt it does make sense from a pure financial perspective, and most likely from a emotional perspective of actually buying the home which you want. That's it so far. This is Moresh. Bye bye.